Every new animator practices animating a bouncing ball, not because the result is particularly thrilling or sexy, but because there are so many important lessons packed into that one exercise. I'm sure you've heard the saying practice makes perfect, but obviously it matters what and how you practice. For example, if you sketch cartoon characters all day, you can make some pretty good cartoon characters, but that's not going to help you draw a realistic human body. Now, if you do some figure studies and you go to school and just learn how to draw a very realistic human body, that can actually make you.
Okay, enough about that. Alright, I'm gonna watch this video later. Save this in my playlist. Just might as well see what I'm doing here. Watch later, I guess. Okay. Alright, I like that one. Just if we can control this a little bit. This is a little bit nerve-wracking, Let's try this one. Yeah. Alrighty. So, good morning, everybody. Just getting started here. Welcome back to work week. Got a nice new plant over here. Excited about new plants in the office. We got all kinds of new plants in our house and our office now, so that's pretty cool. All right, so let's get into this. Welcome to Mogul Apprentice. Today's Monday. We're going to be talking about the basics, the beginning foundations of futures and options trading, so I can teach you guys how to leverage these things and make some passive recurring money with just a little bit of effort. Now, to understand this, you got to understand trading, and you need to understand a whole lot of things. Futures and options trading is not for beginners, that's for sure. But they're also not that complicated. Once you understand the basics of them, I mean, you can learn the basics of these things in an hour, you know, and be at least being able to go and start looking at them at least. And then as I start walking you through how these things work, you'll get less and less afraid of them. It's a lot of lingo in here. Of course, if you have any questions, I'll turn this down a little bit. Fire away, because there's it's a whole new level of learning for a lot of you, I know. So let's get right into it. So first of all, before we get into this, I might curse once in a while. So parental advisory, fair warning. Again, this is all of my own opinions based on my history of doing all this stuff. Please do your own research, and none of this is financial advice. Trading and risking, and you can and will lose money. The best traders in the world lose money still, so understand that. And understand that it typically takes about 2 years for this is for day trading. For day traders, it usually takes about 2 to 3 years before you really start are able to make consistent returns. Now, with what I'm going to show you guys, you'll be able to shortcut that a lot, but only if you fucking listen to me and do exactly what I tell you to do. If you step outside of the boundaries of anything else, you're going to have the same learning curve because you understand why those boundaries are there. So, Monday, this is our schedule for the week. This is pretty rock solid now. I'm pretty happy with this. Today we're Monday. We'll be talking trading markets, and then YYFS you see on the screen there is Yin Yang Financial System. It's a more formal teaching around this, and really this is kind of the first video of that to kind of start laying a groundwork of what talking about here. Just at least the beginning of a conversation, lay the groundwork, so you guys have some understanding about what the hell I'm talking about whenever I start getting into this, so we can get on to the more advanced features of trading that allows it to be such a powerful vehicle that it is. So that's what we talk about today. And then Tech Tuesday bleed into Bleeding Edge Tech, and Freaky Friday we'll just talk about whatever you guys want to talk about. So trading, let's get into trading. So I'll cover my trading history a little bit. So let me get a drink of water here. I was just trying to think of the guy's name now. I can't think of him. I was about to tell you the story. So I got started trading. What year would it have been? I mean, I traded. I did paper trading, model trading throughout junior high and high school. I was always fascinated by it, and I tracked stock market, just kind of the way that they teach you in high school to do it. And I got fascinated by it by one of our teachers we had when I think I was in like 7th or 8th grade or something, and taught us about a little bit about stocks, and we did a little in-class competition about it, and that was interesting for me, and it sparked an interest in just that kind of world, because it felt to me then like it was something that was very mathematic and something solid that I could put my hands on. I'm a pretty ethereal thinker, and I'm very artistic, so things don't have to be solid and spreadsheet based for me, but it's nice, so things like that helps you to not have to think. And so I like things that have me not have to think. So trading was always very interesting, and there is a part of me, there's an engineering side of me that likes things to be exactly right, and trading seems to be that way. There always seemed to be some way that you could figure this thing out, because obviously there's billionaires that have made money from doing hedge funds and all kinds of crazy things on Wall Street. So there's something to it, right? Well, like anything, there's more to the story. So I got fascinated from a young age, but didn't do anything seriously with it involving real money until I was around 93 or 94. So I would have been 23, 24 years old, something like that. And that just got loosely into getting into trading options, which is a weird first thing to trade with real money. I didn't really trade stocks with real money other than like investing in my 401k and stuff when I worked as an engineer. But that was nothing. I didn't know what the hell I was talking about. I just listened to whatever the 401k manager that came into our corporate offices and told us to sign up for. I had no idea. So that was real money, but it didn't mean anything. And we'll talk about 401ks later. Just a short a bit about it. 401ks to me are like one of the biggest frauds in financial history, but we'll talk about that later. So that was my history. But one night I was listening to, or one day I should say, one of my habits was listening to Rush Limbaugh back in the day. I really don't listen to him anymore. It's just I don't think that way anymore. But I used to love to listen to Rush Limbaugh on AM radio at lunchtime whenever I worked as an engineer. And I remember one day there was a commercial that ran, and the guy's first name is Wayne. I can't remember I'll remember his name. But he started talking. It was a commercial that came on the commercial break and started talking about options trading and how you could make a consistent income from trading options if you treated it differently than what typical Wall Street guys treat it like. And the message was a typical marketing message. It was just very well done, and it just resonated with me. It's good copy and all of that kind of stuff. Come to find out later, it's kind of a bunch of bullshit, but it got me started on the path. And so I responded to that radio advertisement and ended up ordering some tapes. Back then it came in a big clamshell case. I don't remember, it was a few $100 or whatever. And to me at that time it was decent investment. I was an engineer, but I wasn't making huge money or anything. So I don't remember how much it was, but I ordered these tapes. These tapes came, and I listened to them, and I learned all about options trading, at least the basics of them. And he explained it in a way that made sense to me. And what the hell was that guy's name? Gotta figure out. Can't believe I can't remember his name. He was a taxi driver. He wrote a book about taxi driver, trader, something like that. Oh, this is just a newer version, same thing. What was this guy's name? Well, it doesn't matter. Wade Cook. Just remember, Wade Cook. Yeah, Wade Cook seminars. Cook options trading. Yeah, there we go. Yeah, here we go. This is a good headline. It's on thestreet.com. Wade Cook posts $1.7 million in trading losses. This is August 17th of 2000. This is after I had already studied from the guy and learned a bunch of stuff. And then he went on to have a pretty big company teaching how to do trading. And turns out that he was full of shit and really couldn't trade at all. And he ended up his whole seminar thing. So I went through his whole thing. I went through all of his coaching. I went to all of his seminars. I went to all of his things. Spent thousands and thousands of dollars. Went through the whole thing and learned the whole deal. It was a great journey for me. I can't really blame him. It got me started on my trading career. And what he taught was how to think in terms of generating income from trading. And up until that time, all that had been drilled in my head, and all that's really drilled into most average Americans or average person's head, is that stock market is long term. You just put your money in there and then you sit, and then you're gonna have, hey Andrew, and you'll have a bunch of money later, right? That's what they sell you, and the whole 401k thing and mutual funds and all that bullshit. I had never really considered the idea that you could make short-term money from trading and actually make an income from it and turn it into a job, I guess, or a business. And when he explained that to me, it opened up a whole new world to me, and it really changed my life in a lot of ways. Good and bad both, but it really did. It was monumental for me, and went on to creating my really first marketing career, where I learned all of this stuff, and I started a meetup group. It was a Wade Cook meetup group. Back in the day, it was early days of the internet. I mean, this is 94-ish, 95, very, very early. Meetup groups weren't even called meetup groups back then. It was whatever it was. I don't remember how it happened, but was it something like a meetup group that we got together? Oh, I know what it was. I remember what it was. It wasn't a meetup group. Meetup groups came later. It was just the people that went to the seminars. We started and went through the coaching. There's a small group of people, and most of those people were older, and I was a young guy, and it clicked with me. So it clicked with me faster than it did for them typically. So we started meeting for lunch and started our own little meetup group from that. And I ended up teaching a lot. And so I went on learning more and more advanced strategies. And then I would come back and teach the people in that meetup group. And they would go off and learn these things and make some money from it. So this over several years, this built into a pretty good following, and ended up me having several thousand people that would pay me to come and speak and teach them trading strategies, and all over St. Louis, Chicago, all over Midwest. I would travel. Sometimes paid up to $10,000 a day just to teach about trading, and from that, I developed a following. People that liked what I had to say and were and executed the ideas and strategies I was teaching them, and then we'd come back and compare notes weekly at our meetups, and was going really well. Well, several of these people had a lot of money, and they decided to get together, and they wanted me to trade for them. So instead of, the whole idea of me showing them every week what my picks were or what I was doing, and they'd try to figure it out when they got home. Sometimes it didn't translate well. Sometimes I'd be making money on trades, and they would lose money on the exact same trades, which can happen. It turned into the thing where I eventually pitched the idea of them, like, hey, why don't I just start a hedge fund, and we all just pool money and go and do that. So did that, and hedge fund ran for a couple of years, did really well in the beginning, and traded futures, options, mostly S&P 500 futures, all kinds of different strategies that I'll teach you guys, and I explored it all. You name it, I tested it. And we sometimes had trading systems that were trading 200 trades a day. Sometimes we had systems that would trade maybe two trades a month. So I ran the gamut of testing. I hired the best experts I could get to come in and write software for us. And eventually I learned how to write software for trading systems. And it was a pretty wild ride. It ran for about 3 years, I guess, and ended up with me. I made a lot of money. Everybody did really, really well. The first year we did like 1,200% ROI, just unheard of. And that was incredibly risky back then, and we'd have big winning days. It was several million in the fund, but it wasn't a huge hedge fund. It's less than 10 million. But for a little kid from middle of Missouri, it was a big deal for me. And I had never seen that kind of money in my life, and made some immature mistakes. I was in my middle 20s. I had never been around money. I grew up poor, man. I grew up on food stamps and holes in the floor and holes in my shoes, and to go from that to at 25, 26, 27 making millions of dollars, it messed with me. And so I didn't have mentors. I didn't grow up with mentors. I didn't have a good support structure for any of that. I didn't have a mentor like a rich dad, poor dad kind of thing. All I had was poor dad and poorer stepdad. I didn't have shit. I didn't have anybody to tell me what to do with anything. I had to learn it all from going to seminars and reading books and going to coaching programs, and then eventually falling on my face. And so through it all, I learned how to trade. I know fucking trading, man. There aren't many people out there that know more trading more than I do. But I've kind of, it's one of these skill sets that I've kept under a cover for a long time, just because it caused a lot of drama and a lot of pain and struggle in my life, still to this day. Because my hedge fund, though, it did really well, and the strategies that I'm going to teach you guys are the exact ones that we traded in there. We made fantastic, huge money. I just made bad business decisions being a young age and not knowing what I was doing with money, and got way over my head and way too risky. And one of the things that it was a very hard fought lesson for me to learn was a lesson of portfolio sizing and how to risk position sizing. Position sizing to manage your risk, and then portfolio sizing to alleviate the ups and downs in the risk. So that's where the yin yang financial system has come from. That teaches all about not just how to trade, but how to trade with the right size of trade. Because you can have the best fucking trading system in the world, and if you're not sizing the trade the right way, you're either going to be losing money from a winning strategy. You can lose money from a winning strategy because you don't put the right size of trade on. And that's when it really messes with you. And that's very close to what happened to me in the hedge fund, because the hedge fund eventually went down, and went down as a really short, nice way of saying all the money got lost, and I ended up spending 2.5 years in federal prison for breach of fiduciary responsibility. Essentially, the short story is I I took my foot off the gas and I wasn't paying attention to trading, and I turned the trading over to somebody I barely knew, and I believed their story about what kind of trading system they had. And I frankly had a lot of money and I wasn't paying attention. And I just turned responsibility over to somebody else, and they lost all the money. Well, my arrogance, young dumb arrogance, I just said the reason I went to prison, because there's nothing illegal about losing money, especially when somebody else did it. But what made me go to prison was that I didn't want to admit that fact to the people in the hedge fund. So I lied to them. I told them that we lost a little bit. I think I told them that we lost like 30% or something in a month, which is a gigantic loss. I mean, it's just insanely huge loss in a month. But we'd had a good run and everybody trusted me. So I said we had this big loss, and then my intention was to come back in. I was going to put my eye back on the prize and come back and trade again. But something you'll learn as I teach you about trading is hard enough on its own. It's one of the hardest things you'll ever have to learn, because the trading itself is not hard. It's extremely easy. But what's hard is mastering yourself, the one that's just going in and out of the trades and changing your trading strategy and all these things. Because when things start going wrong, man, it's like Mike Tyson says, famous Mike Tyson quote, everybody's got a strategy until they get punched in the face. And trading will punch you in the face and the nuts and rip your throat out all in one move and then laugh at you. Because it doesn't care. It's just a bunch of numbers going up and down. And what people, as humans, we are wired to search for patterns, and we look for patterns and things. That's why charting and trading feels so good. We can draw lines on things, and we can line up triangles and shit. It makes it feel like we're doing something because we're looking at the pattern. But here's the thing, it's also not completely random. So there's either a pattern to it or it's completely random. The reality is it's got all of it mixed. So it's not that solid. So it can look like it's got a pattern. As soon as you lock into a pattern, it's like the pattern is not there. It's going to go the other way and try to prove you wrong. So it's an interesting thing to learn how to do. And I went all the way in the deep end, man. I went as deep as you can go, all the way to working with guys on the floor of the Chicago Mercantile Exchange. And the main guy that I met on the floor of the Chicago Mercantile Exchange was a guy that I turned over the trading to. He lost some money, so it's what they call a breach of fiduciary responsibility. Basically, if you're entrusted to manage money for other people, which we had a legal hedge fund set up under Regulation D, under an exemption I think is Section 504. Yeah, Regulation D, Section 504. It's an exemption, so you don't have to go public. You can have, as long as you're registered, you can still solicit money from people. You can't advertise. That's changed some now with the new crowdfunding laws. But the point is, it was a legal hedge fund, set up legally. It was spent, a few $1,000s. It wasn't that expensive to set up. It was a legal entity that allowed me to create a trading account. Really, it's multiple trading accounts, so that I could trade under one entity. The hedge fund really came out of the fact that I was trading for people, but I was having to log into their accounts and make trades. And after it got to like 20, 30 people, it was great because I was making money for people and they were giving me a percentage of it. And I was making money. Everybody's making money. Is all great and everything. But what was happening was when I was starting to put on trades, I would have to go log into 20 accounts and then log back out and place a trade. And then, all that stuff. Doing that multiple times got very overwhelming. So I eventually told him, like, hey guys, why don't we put this together as a more formal thing, and then I can trade one account. Then I can focus on the trading instead of logging in and out of everybody's account all the time. It works great. I mean, if it would have stuck to that, of course, stick to the basics, who knows where I've been right now. I probably wouldn't be sitting here because decided with a different path in life. Who knows? The point is, everything that led up to that point was trading strategies that worked. And ever since then, the same trade strategies have continued to work. And the people that I've taught these trade strategies and kind of gone on to do them consistently and didn't break and go outside of the rules are there for a fucking reason. I'll explain all the rules so you understand the reason. But the people that have done it have gone on to make huge money. And I know a shitload about this world. And I'll tell you the truth about what works, what doesn't, and all of that. I've made and lost millions of dollars. I had the unique distinction of having one of the largest margin calls in the history of the Chicago Mercantile Exchange. That was $18 million a day margin calls because I had a guy that hired trading for me that was... He just put on the wrong trades, and we had such a history there that they let us put on these giant trades, and thankfully it worked out and we made money from it. But I could have lost tens of millions of dollars in one day if it would have gone the wrong way. So that caused a giant margin call, which caused me to have to shift my trading strategies going forward. And that was back in the days of doing open outcry. I was doing open outcry from my office. Meaning I'm having to physically call in on a phone. You pick up the phone with a wire on it and call the floor and make a trade. I was making so many trades that instead of calling my floor broker constantly, we set up an open phone line and left it open phone line on the speakerphone in my office, my trading office, through the entire trading day. And then we would just basically, it's kind of like being on the trading floor, but I was in St. Louis and Chicago Mercantile Exchange is in Chicago. It was an interesting setup. And back in the day, this was in the 90s, man. This is when electronic trading first got started. It's 97, 98. When I first started trading, the very first S&P 500 electronic traded futures. They called them the E-mini, electronic mini contract. And what it did was it opened up this, what had been only institutional only level trading, which the S&P 500 is the gold standard for trading. Like, where is the market at? The S&P 500. The S&P 500 futures, which we'll talk about a little bit. This is getting a little bit long, so I might have to extend this into some other days, but I got a lot of stuff to teach you guys, so we'll get into it. Now, I'm going to put together I've still got the slides. I haven't completed all of the videos for the Yin Yang financial system yet, and I will get into more of the expanded trading. You guys, I don't know if Andrew or not. I'll talk to Andrew about it later, but my original trading videos, you guys are supposed to have access to. I don't even know where they're located anymore. It's been so old, like old stuff. So I taught my day trading strategy in those. And day trading strategy gives you an idea of lots of things, charting, some basic technical analysis that works, that kind of thing. I'm probably just going to go back up. I actually need to look at those videos and see what's there, and then just teach you guys from a base. But before we get into any of the technical stuff, you need to understand what this is all about. So I just wanted to tell you my history, and this is not even just a tiny slice of my history with trading, guys. But once you understand, I've been around the block. I've tried. If there's something that involves trading, I have tried it, and probably on a very, very big level. And I've tested it. In my early days of doing this, I was a fanatic tester. I would run spreadsheets and run just craziest tests you could ever imagine, and we learned a lot of things about something called walk forward optimization, where you can optimize trading strategies by walking them forward across real-time data to tell whether your trading strategies will work going forward, but after testing them on historical data. What happens with trading system testing is, and this is what most of the industry is, most bullshit, especially the people that are selling automated trading bots and all this kind of shit. What they do is they will, create these bots with some sort of solid, sound strategy that makes sense, and then they'll test it against historical data. Against what did the market do before with this specific strategy, and then they test it, and and then they get you results, and it spits out results, and it tells you, oh, this strategy won X amount of times and it made this much money. Okay, well, that's really easy to do. It's incredibly easy to come up with a strategy that does that. But the problem you run into is with the level of technical things that you can do with tweaking, which you'll see just a tiny percentage of these when we get through these. But it's just an infinite number of levers that you can tweak with strategies. So what happens is people tweak these things so damn much to get it to have the most optimal results over this historical data. Is what they do is end up fitting the trading system to that data. It's called data fitting. In statistical analysis, it's called data fitting, where you're taking your data and then creating the perfect scenario for it. So if you had the absolute perfect trading system through that, what the market had done through all the years up until now, then you have this trading system. Well, that doesn't mean shit, because the market doesn't give a flying fuck about what happened yesterday or 3 months ago or 20, 30 years ago. It doesn't matter how far back you test. So people can show you all kinds of glowing reports, and they'll be accurate of trading systems that have done so fantastically great results over, weeks, months, decades, whatever it is. But that strategy is to lose money from day one and never make money going forward in real data, using real data, or using real-time data, I should say. It's called data fitting. And that's a major problem with all trading systems. So the only way that you can correctly validate a trading system is with walk-forward optimization. And walk-forward optimization just means that you take your strategy that was optimized to fit over this data, and because you can't go forward in time, and you don't want to risk real money until you know the thing works, what you do is you do walk-forward optimization. Walk-forward optimization does is it takes that model and it goes back to the beginning of your data and then trades it going forward as if it doesn't know any of that stuff. And then things change. And then so the best walk-forward optimization takes just random spots out of all of your data. And the longer data set you have, obviously, the better. So what you need is more trading data. So what I did was I went back and I bought, I still have it on a disk somewhere. I bought, it's probably available online now in a much simpler format, but I went back and bought all the tick data. So when you see movements in the stock market and in any instruments that's traded, there's a minimum amount that they move, and in the S&P 500 it was 10 cents on the big contract. So a minimum move is 10 cents. On stocks, it's typically 1 cent. In the old days, stocks, it used to be a 16th. Remember those days? Then we went to decimalization in the 90s, which changed everything. So there's a minimum, so like most of them are 1 cent now in stocks. Some of them have $1 minimum movement. Just depends on what the underlying is. For the S&P 500, the big contract, not the electronic mini one, the big one is 10 cents. So every one of those movements, those 10-cent movements, is called a tick. Tick is the minimum amount that an underlying instrument moves, and just since the tick data. So what you buy is this historical data. Is called tick data. So I went and bought all the tick data from when the S&P 500 futures started trading in 1982. And that's kind of the gold standard for day traders. Well, all kinds of traders, but a lot of day traders. I won't say day traders. I won't pigeonhole anybody with that. But just traders they're creating trading systems, whether they're automated or not. Typically, this is for automated trading systems. We'll go take this tick data and go forward and go do walk forward. Sorry, there were two technical analysis on all this data to try to create a trading system that will work from this data, right? So that's what I did, and I spent a shitload of years doing that, tens of thousands of hours, millions of dollars, quite literally invested in learning what works and what doesn't, and I did it. I've done it. And I can tell you, it's incredibly hard to make automated trading systems because they always fail in walk-forward testing. So in walk forward testing, what we do is you take all of this tick data, and then you take a trading system that you've come up with and kind of optimize it for whatever data that you have. And then we go back and we take it through a random set of data and walk it forward as if, okay, we're going to drop this trading system right in the middle of 1985 at this time, and it's going to go forward 3 months. So that entire discipline there's an entire community. It's all nerdy, like off the charts, incredibly smart people in there that can't figure out how to fucking trade. They do all of this crazy, all off the charts analysis, and they figure out these automated trade systems, and they're all still broke, hanging out in forums, programming, and nerding out with each other. And there's nothing wrong with any of that, but the point is, I've been there, I tried it, I sold trading systems, I built trading systems, thousands of these fucking things, hundreds of thousands of them that didn't work. So what I built was systems that tested trading systems. And those are my early days of computer programming. It was a lot simpler back then. The world was a lot simpler back then. So we did a lot with spreadsheets and programming spreadsheets to run tests. And early days of Lotus Notes, taking all that tick data and then eventually running it into Excel. And then eventually I learned how to program Visual Basic and build my own interface on top of Excel spreadsheets. And that's kind of what launched my programming career in a big way. I mean, I was already a programmer as an engineer for manufacturing and aerospace, super high precision manufacturing stuff. But it's a totally different discipline. It's still programming, but I didn't consider myself really a programmer until I really started trading really high-end data analysis for trading systems. So I did it, guys, and I built trading systems. I sold one to a very high-end bank. I sold one to a bank in Central America. I sold a trading system to another hedge fund manager in Chicago who ended up fucking me over on the deal and didn't pay me for it, and then bragged about later how he made $400 million from it. Cocksucker. Well, the cool thing about that is that his wife left him, and he's an old, destitute guy now. He has a bunch of money, but everybody hates him. But the point is, I built things that works. I know what works in trading. So if you guys listen to me and trade with the right size, over time you can create a very nice life for yourself. I mean, it's what the basis of multi-million-dollar, billion-dollar empires are built on. Exactly what I'm telling you guys. The only difference you have is, the account size that you're dealing with, which opens up other possibilities. With the overall idea here is not to just create long-term wealth, because who cares if you're 80 years old and you got a bunch of money and you haven't lived. What you want to do is create income along the way, and so you can live now and also grow it into long-term wealth. So through that, I envisioned this idea and created this whole idea of the yin-yang financial system. The yin-yang, I call it yin-yang because it marries together all two sides of ourselves. We all have gamblers inside of us. Who doesn't love to go to Vegas and put it all on red once in a while, or play some poker, or whatever it is. It's just fun once in a while to gamble a little bit. Put a little bit on a horse race, or bet on a baseball team, or whatever. It's fun. I mean, we bet $5 a hole sometimes on golf, Sometimes I stop doing that because I lose a lot. I have to say enough. But it's fun. We just love how we'll have a gambler side of us, So, and the stock market really, really, really picks at that. I mean, it's what it's built on. Because the stock market and all of trading is nothing but a casino with a clock. I mean, it's nothing but a casino with a clock. And if you play long enough in the casino with the wrong strategies and play at the game that the casinos, aka the brokerage firms and all the big guys out there, the guys that you're competing against in this trading world, if you play at the game they want you to play in, if you just do it over and over and over enough, they eventually end up with all the money. Because there's a spread you have to overcome. You're always trading against a spread. And it's called the bid-ask. This is a term you're going to have to learn. Google it. Learn it. Bid, ask. Wholesale, retail. Everything has a spread. So this is where the crux of everything falls apart in trading. It's super easy to come up with trading strategies to make money. But as soon as you throw in that spread, then you've got a big problem. So this is a fundamental thing you've got to understand. The bid and ask is this. It means that you have to buy at one price and you have to sell at another price. And that spread always benefits the casino, okay? So whenever you buy, you have to buy at the high bid price, that's the bid, and the sell is the ask. So it's the same as any auction. Whenever you're trying to buy something, hold on a second. All trading is nothing but the same as an auction. Auction is trading, tradings are auctions. So in an auction, you're bidding on something, right? Well, in trading, you're also bidding on something. When you put in an order to buy, it's not just an order to buy, it's at a specific price, and it's got to match whether the bid and ask are there. So for example, you put in an order to buy, you've got to buy it above where the market is, or you're not going to be able to purchase it. You've got to bid higher than where the market price is right now so that you can sell it. Or sorry, so you can buy it, because somebody is asking on the other side, somebody is asking a certain price. That's where the bid and ask comes from. You can think of it as buy or sell, you can think of it as wholesale, retail. Whatever terms you need to use, either way, it's a spread. You always have to buy it at a high price and sell it at a lower price. And whatever that spread is, you always want to have the spread be the smallest it can possibly be, obviously, because that's how the brokerage firms get paid. That's how all of Wall Street gets paid, is that little tiny spread. And that spread is very, 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 very fucking difficult to overcome. It's damn near impossible. The game is rigged. Top to bottom, front to back, inside and out is completely rigged. And that rigging is that spread. To overcome that spread means you have to be better than 51% of the time, not better than 50% of the time. If you only had to be better than 50% of the time, that's just beating a coin flip, everybody'd be fucking millionaires in trading. That's super easy to do. Super easy to do. But the trading bots and trading systems that you see all over advertised everywhere is exactly that. They're just beating a coin flip, and then they show you all this flowery data about how awesome it is. But then whenever you go to apply it to a real world, three things happen. One, walk forward testing fails because it's not walking forward on real, live, real-time data. Number two, the spread is not factored in. So as soon as you take that out, most trading systems fail just from that alone, even without the walk forward testing. And another thing that doesn't get factored in a lot of times with trading system is commission. So that commission gets added into the spread. So a lot of trading systems, even the higher end ones that go for thousands and thousands of dollars and have all kinds of huge followings, don't fucking factor in commission. So when you try to run it yourself, you don't make any fucking money. You're sitting there wondering why. So I'm telling you guys, you got to factor these things in. So bid and ask. When you're bidding, you're placing a bid to buy, and somebody is asking a certain price. So you've got to bid above that ask price to be able to get that, and that's where the spread comes from. So there's always one side. There's always two sides of the market. There's buyers. There's sellers, and the sellers are on the ask price. They're asking a certain price, and the bidders are bidding, and they're always trying to beat each other. You know, because everybody's trying to get a deal, and this has happened constantly. So this is what makes the prices go up and down. Because if you're bidding, you're bidding up. That's what they call bidding up. So you're bidding. You can bid the price up. And the sellers will take it because they're asking higher and higher prices. If they're selling and the price is going up, they're like, okay. Well, eventually that equalizes out. Eventually the guy that's saying okay, he runs out of inventory. And then, you know, when the market runs out of sellers, then the only one way it can go is down. That's completely wrong. I just told you wrong. When the market runs out of sellers, the price can only go up, because if you got nothing but a shitload of buyers, then the market's going to go up. So that's where the whole supply and demand thing come in. That's what you have when you have price discovery. That's where true price discovery is supposed to come from. So if there's a small supply of sellers and you keep bidding it up, eventually the price will get bid up enough where it exceeds their asking price and they will sell. Well, then the other person on the other side is also trying to make a profit, you know? So the buyer turns into a seller then. So the whole game goes back and forth, and that's how these fluctuations happen. So when the market runs out of buyers, the opposite thing happens. You see, markets typically will go up in stair-step patterns. It takes a lot of work to go up, and then will fall dramatically down. An elevator down is what they call it. Stair-step up, elevator down. That's because markets will fall under their own weight automatically. Just because any market that's all you got to have is a lack of activity, and the price automatically falls. So there's automatic movement down. You have to have a lot of constant movement and all new energy and new things going into a market to make prices go up. So that happened, that energy, the momentum, the steam, the number of buyers, all these factors runs out quite often. And what happens is you get these precipitous drops in price, because all of a sudden the sellers are like, oh shit, I can't get this price anymore. So then they're dramatically dropping prices. You know, they're going on a sale. Everything's on sale. Summer closeout. It's a back to school special. It's the same thing. They just drop the price until buyers start coming in again. That's how price discovery happens. That's what price discovery is. That's what it means. Markets trade so that you find out like what the price of something actually is. And the price of something actually is just what people are willing to pay for it. That's it. So markets, that's all they are. Is a whole bunch of auctions going on constantly. People bidding on, hey, that's a good price or not a good price. That's all it is. And if that was all pure and easy, if that was all pure and it was just pure price discovery like that, markets would be a whole lot easier. But as I've already mentioned, you got to throw in things like spread. The spread changes everything. The spread is what makes the whole game rigged. You throw commissions on top of it, makes the spread even more rigged and the game even more played, because then all it turns into is all these guys manipulating everything for that tiny little spread plus those commissions. That's how the entire industry is driven, sucking the life out of it. And that's all how casinos are driven. I mean, the entire industry of any of this stuff, it's all wholesale retail, bid ask, buy sell, work the spread. I mean, it built all of Vegas. Same idea, just a different mechanism. So you got to understand this spread, because it's what we're fighting to overcome constantly. So you can learn all these great trading strategies. I'm going to show you all kinds of cool things. We're going to go through all kinds of lingo. You're going to have to learn a whole new language. It's a lot of stuff. But in all of this, what often happens is people forget that all we're trying to do is overcome the spread. And the only way you can overcome the spread really is and it's not having a trading systems that have a high frequency of winning. That doesn't work. I can show you all kinds of trading systems that have a 99% win rate and lose money because they don't control risk correctly. Because you can have one losing trade that wipe out all 99 winners because risk isn't controlled. So if you got a controlled risk system that for example, you are betting $1 to make $2. If you're always betting $1 to make $2, you're at least on one side of the equation okay. That doesn't mean it's a winning strategy, because you could still have a low win rate that would make that not work anymore. You know, if you're below 50% win rate, that's still not going to work, you know. So you got to have these factors all balanced in. There's a whole lot more to them, and I'll walk you through them as we go through them. But again, the idea here is that we're always working to overcome the spread and to create a consistent income for us at the same time of growing long-term wealth. And I've got all the systems. I'll teach them all to you. So let's go through the basics of futures trading and options trading, and we'll wrap it up. And so futures trading, what are futures? Well, futures are contracts that are traded on exchanges for fungible item. Fungible just means that it can be mixed together. Fungible, I mean, mixed together with no real identity of an individual item. Example would be commodities like gasoline, oil, corn, soybeans, pork bellies, lumber, all kinds of things that if you put it in a big pile or in a big vat, you couldn't tell them one from the other. That's called fungible. It's mixable. So they're sold and traded in big lots of them. Versus non-fungible items would be like a share of stock. You get a stock certificate and it's numbered specifically, and that's one specific share of that stock. That's not mixable. So that's not fungible. So futures cover commodities typically, which are those kinds of things. To extract that even further, they've taken futures and applied them to indexes. An index is something you guys hear all the time, like Dow Jones 30, S&P 500, the NASDAQ. You guys hear all this, the NASDAQ 100. Those are indexes. What the index means, they're just taking a basket of things and doing some mathematical formulas and averaging them together and saying this basket represents this. So the S&P 500 is 500 of the biggest companies in the United States that really kind of shows the breadth of the market because it's 500 companies. The S&P 500 number is really considered more of what you would call the market. Like, where is the market? Now, what's quoted in the newspapers and all over media all the fucking time is Dow Jones 30, the Dow Jones Industrial Average. You hear that all the time. That's the Dow Jones Index. The Dow Jones Industrial Average is 30 companies. It's the 30 premier companies in the United States, and there's people that decide which 30 companies there are, and they change over time. But it's supposed to be the 30 biggest companies. Well, that's not really the broad market. So the S&P 500 is considered the market or the broad market. So because the index has over the years that was created by Standard & Poor's, that's what S&P stands for. Standard & Poor's is a rating agency that rates companies. So they created an index and put 500 of the best companies in there, and they then average that out. They do some formula, and that's what the number they come up with. And the S&P 500 just recently went over 3,000 for the first time in history. Well, because traders, hedge funds, institutional level people that manage big money, and the real people that understand market see the S&P 500 as the market, futures contracts were created to trade that as an index. Even though it's not orange juice, it's not lumber, it's not soybeans, it's not gasoline, it's none of those, it's not like a real commodity, it's still an index thing that can be traded. So futures contracts are typically settled in the commodity. So if you go buy oil futures, go buy an oil futures contract, and then it expires. So futures contracts expire. That's an important thing here. When the futures contracts expires after you bought it, they're going to deliver you X amount of barrels of oil. That's how it's settled. So it's called commodity settled or asset settled. The index futures, because they're not connected to orange juice or oil or gasoline or any real commodity, they're just connected to an index. They're called cash settled. So futures contracts were created to control price. So without futures contracts, they're called futures because they're executed based on a future price. They're typically futures contracts are quarterly. They expire quarterly, and you can buy or sell any quarter that you want, but typically the current quarter is the one that's most actively sold, or actively traded, I should say. So without futures contracts, what happens is, so for example, gasoline. A gasoline producer or somebody that is buying and selling a lot of gasoline. Airlines, for example, buy and sell gasoline or oil futures contracts. They buy and sell them constantly so they can predict the price of their fuel. Because without futures contracts, you would have to go strictly by supply and demand to price things. So without futures contracts, for example, if you went to the gas station today, gasoline could be 25 cents a gallon, but tomorrow it might be $15 a gallon or $50 a gallon, and the next day you go back and be 5 cents a gallon. Prices would swing so wildly it would be hard to manage. That's what happened whenever in the beginning before futures contracts are created, because then you're strictly relying on supply and demand at that moment. Meaning, if all of a sudden a whole bunch of people come to the gas station and there's only a small amount of gas, the price is going to go way up. Or tomorrow, so the gas station all of a sudden panics and says, oh, I need a whole new shipment of gasoline. So he brings in a whole bunch of tankers, and then the next day, nobody shows up. Then he's going to have a fire sale and drop the price on his gasoline significantly to get people to come and buy it again. That kind of thing would be happening in every marketplace across everything that we buy and sell in the entire world. So futures contracts create price stability because everybody's hedging against the future price. You know, these prices go up and down all the time, but it kind of helps even them out, is what it does. And it helps big companies that trade in these big commodities to kind of predict and manage the risk and things going forward. And it's just a powerful tool, very powerful trading tool, but it's a derivative. It's something's called a derivative. It's not the actual market. It's a derivative of the main market. So futures contracts are done that way so that, you know, you, like an airline, for instance, they want to say, I want to be able to buy my fuel in 90 days at this price and know that it's going to be at this price because I know the market trends are headed this way, and so I know it needs to be at this whatever price it is. You know, they do their own math. So they'll go either buy or sell a futures contract to lock in these prices. Well, then 90 days later, say they buy a futures contract for the fuel. 90 days later, that contract expires, which means it gets executed and it's got to be settled then, a commodity settled. So once the contract is executed, when it expires, the airline pays the money and then they get shipped the fuel. Well, you can get out of these contracts and not have to worry about it being delivered just by settling it and taking the opposite trade before it expires. So what happens a lot of times, a lot of traders just trade the contracts back and forth, and they're not really caring about getting delivery of the actual commodity underneath it. They're only trying to make money on the movement in the price. I mean, that's what trading is. So that happens in the futures market. And what it does is it creates for a very, very efficient marketplace. Because futures, to me, and to most people that trade and know the markets, is pure trading. It's clean. It's pure. You're just simply buying and selling. There's only the spread you got to overcome, and then trying to forecast the price a little bit, and that's it. Every other thing outside of that trading has got all kinds of more complications to it, including stocks. Stocks are more complicated to trade than futures. Futures are the simplest thing because it's just strictly buying and selling. And if you learn to specialize in a specific futures contract, you can get good at it, and you can learn how to start to read the tea leaves, read the technical analysis, read the charts, get a feel for where the market is, and overcome that spread through strategies short and long term. So that's what futures contracts are for, and that's why they're traded. How do you trade them? Well, you trade them just by opening an account, and I mean, it's really simple to trade futures. You just open an account and put in some money. It typically requires a little bit higher account balance. By higher, I mean a few thousand. Like, you can open a futures account with $5,000, so it doesn't take like a lot of money. But you have to open a specific futures trading account. And we're going to talk a lot about trading futures. because it's what I spent the most time doing, that and options trading. Options is actually the longest time, but futures is what I spent the most analysis time in, because it is simple yet deceptively hard to do because of that spread. Now the strategies to trade them, there's the day trading strategy. Day trading is one of the hardest things you'll ever do in your life. We will cover that a little bit. It's not really something I recommend for anybody. It's too fucking hard. It's draining on you psychologically. It's not worth it. It turns into a grind. It turns into a really shitty job. So I don't really teach that. I don't really recommend it. However, you can do it. You guys have access. If you don't yet, they will be in the members area within days of the My Day Trading strategy that does work. I don't do it anymore myself just because I just don't like spending my day that way. However, I know the strategy very well. I did it for a long time. So I'm happy to talk about it. Teach you guys that. If you want to run with that, fine. The other strategies is with the longer term stuff. And futures contracts are not really great typically unless you're a bigger entity that are doing stuff with them in ways that typical retail traders not. So the only real strategy I recommend for futures trading, if you're going to do futures trading, is kind of a day trading strategy. You can do some position trading stuff, which we'll talk about in the future, which is position trading just means not day trading. It's a longer day. Position means you're going to hold a position overnight. Day traders, what's great about day trading is that you're flat at the end of the day. Flat at the end of the day means typically you're not holding any positions. You're not going to bed on any trades, they call it, or going to sleep on trades, or a lot of ways to say it. But what it means is that you make your trades during the day, the trading day, and then at the end you've closed out all of your trades, and you're just back to cash at the end of the day. And you make or break your money, but it pays your bills and builds your wealth and all that stuff based on what you did that day. Very intriguing, and there's all kinds of great ways to do it. And maybe I will get back and do some live day trading with you guys to show you. It's kind of fun when you get into it, but it takes up a lot of time, though, because you have to sit and watch the market so closely. So I've already taught that stuff. Those are already in videos. You guys have access to them. I teach some strategies in there. And we're also going to talk about position trading. So position trading means you will hold trades overnight. You'll hold them for a couple of weeks or maybe even a couple months at most. So that's more of the get in the yin and yang side of stuff. So you got the yin stuff that's a little crazier. Yang is a little more solid and longer term, build some wealth. You need both kinds. So options trading. Actually, because we're getting a little bit late here, I'm going to leave this for another video. But we've talked about options trading. I'm not going to get super deep in it. Actually, I'll just go through this real quickly. We covered it in previous videos last week a little bit. But what are options? Options are a little bit more advanced version of a future contract. That's why options are kind of get a little bit murky. They're harder to understand because they're not as clean and easy as futures. Futures, you just buy or sell, right? That's all there is to it. It's clean, easy. With options, there's calls or puts. Two types of options contracts. Calls increase in value, or increase in price, I should say, whenever the underlying option or underlying asset goes up in price. The puts increase in value whenever the underlying asset goes down in price. Options are just like trading an option on a house or buying an option on a house. An option is an a right, but not an obligation to perform. So an option would be, say, you buy a house. I bought a lot of houses this way back in the day. You get an option to buy, and just means that typical option to buy a house would be you put a little down payment, and then a percentage of your rent that you pay monthly would go towards the down payment. And that option, so that gives you the option of buying the house in the future. The options typically would set the house at a certain price. So what you do it so that you lock in a price. Very similar to futures contracts, in that you're locking in a price in the future. So that's why you would do an option on a house. The same reason you do an option. So we do options trading on typically on stocks, but sometimes on indexes as well. We'll do S&P 500 options instead of futures. That's a different play. This is where we'll get into the trading S&P 500 in the longer term wealth building ideas, but also still be able to create some income from it as well. Options are just a little bit different beast. They are trading on different exchanges, and they're complicated because they're not only calls and puts, which are two different sides, but there's also, you can buy or sell either one of them. So you can buy calls or you can sell calls. You can also buy puts and you can sell puts. And I don't mean like just a typical transaction like you're thinking, like you go to Walmart and you buy and sell something. No, I mean you can sell calls first or you can sell puts first. So this is an important thing you need to understand about the stock market. Now, the old adage with the market is that the buy low, sell high, right? Well, the opposite is also true, and you can also do the opposite. Sell high and buy low. Sell at a higher price and buy it back cheaper. That's what you can do in futures contracts. If you think the market is going down, you think the S&P 500 is going down, you can sell a futures contract right now without having anything. You just put up some margin. It's called margin. You're just basically putting up a small percentage. And then you sell it right here. And if the price goes down, then you can buy it back. That's which zeroes out the transaction, makes you flat again, and you make money. Now, if you think it's going down and you sold it first and the market goes up, then you lost money because you got to buy it back at a higher price. So that's easy to understand in futures. That's all there is to it. You're either buying or selling. You're either long or short. Are you hoping the price is going to go up? That means you're long. This is more terminology here. Short means you're expecting the market to go down to make money. So when you're short something, you're wanting the market to go down. And when you're long something, typically you want the market to go up. Well, that gets a lot more confusing in options because the same thing is true. You can sell something before you own it. That's the important concept in trading. You got to understand. But you always got to buy it back to close out the transaction. So the same is true in options. You can buy or sell a call or a put. So a put, even though it increases in value when a stock goes down, if you sell it first, you want the opposite to happen. So if you sell puts, you want the thing to go up because you sold it. You captured the money first. You want to drop in value so that you keep it. That's a little bit more advanced concept, and we'll talk about future. That's how you start making money from this stuff. That's how you start building in some recurring stuff, because selling puts is one of the most beautiful strategies there is, because it makes money 2 out of the 3 ways in the market. Because the markets either go up, down, or sideways. It's super easy to make money if they're going up or down. It's really hard when they're going sideways. That's where everybody loses money, when things go sideways. When strategies don't work the way you thought they would. They don't follow through the way you thought they would. Up or down. When markets going sideways, everybody's losing money. You get chopped up. You get chopped up by that spread. You get chopped up by commissions. You get chopped up at getting in and out of your trading strategies. You get chopped up psychologically because trades aren't following through up or down. So we fix that with options. And you can fix that by selling options, selling puts, because selling puts, you make money 2 out of those 3 ways. If the market goes up, you make money because that means that put option goes down in value, which is normally bad. But since you sold it first, you got that money that it was purchased for, and then it goes down in value. Then it expires worthless, and you made money. That's what you want. So it makes money when market goes up. It also makes money when the market goes sideways, because both futures and options contracts have something built into them that are unique, and that's time premium. Because they expire eventually, they've got a premium built into them that's time of price. That's time that's built in as price, and over time that time premium goes down. So as it gets closer and closer to expiration time, futures and options contracts automatically decrease in value because they're running out of runway. They're about to expire. So in the beginning, and when a contract first starts trading, it has a whole lot of time premium, and over time it shrinks and shrinks and shrinks and shrinks, and eventually goes to zero when it expires. Now, when you're selling puts, when this strategy, you're capturing that. You're automatically capturing that because time, you can't stop time. Nobody can stop time. We haven't figured that out yet. Unless you sneeze. You sneeze, you stop time. But we haven't figured out how to do it trading. So what we do is you take advantage of that time decay, of that time premium that's built into options. And if the market just stays sideways and you sold this option up here for this price, and the market stays sideways, that time premium shrinks and shrinks, which means the value of that option goes down, which is what you want because you sold it first. So what it does is it creates revenue right now, which gives you income you're looking for right now, which gives us, we live in a monthly payment society, gives you that. But also over time, you can use that because it helps you to leg into longer term trades. So you'll understand that later. This can get fairly complicated, but once you understand the basics of this, you'll grasp it, you'll see it. It's addicting to learn, I'm telling you, because this is when you start to put money to work. So selling puts and using option strategies allows you to do these things like making money 2 out of 3 ways. Now the market, if it goes down, you're going to lose money, but that's how you build into your risk. The great thing about options is they eventually expire, and you can control how much that you lose on them. Because once you're in the contract, the amount is set. And you can calculate that before you enter the trade. So you can know where you're going to make money or lose money going into a trade. Calculate it before going in so you can control your position size, you control your risk going forward. And if you've got a good position sizing system, like I've told you, that has a certain level of expectancy. This is another terminology you're going to have to learn, expectancy. Expectancy means that for every dollar you put to work trading, it means it's going to make more than $1 back. It's expecting to make a return. But once you figure that out for your trade, then you just want more opportunities to trade. So that's why we trade options. How to trade them, I told you a little bit about that already. We'll talk about that in the future. Strategies, one of them is selling puts. And another more advanced strategy that we do with that is spreads, so that you'll buy a call, sell a call, buy a put, sell a put all in one trade, so that it captures in more of this time premium and allows you to capture more of that actually in less volatile stocks and things. So that's a little bit more advanced stuff, but I want you to understand at least the basics of this going forward. So that's it for today, guys. We'll cover more of this in the future, and I'll get this yin yang financial system kicked off starting now. It's a good time to do it in the summer because summer is typically a terrible time to trade. Everybody's on holiday, so it's a good time to sit back and learn it. Low pressure system. So that's futures and options trading basics for today, guys. We'll get into more advanced versions, and I'll show you exactly how to put on a trade, how to take it off, and how to manage your risk, and how to track all of them in a spreadsheet, which you guys will have access to soon. I have all kinds of crazy spreadsheets to track these things. I'll show you how to read an options chart. I'll show you how to read an options table, I should say, so you can figure out options price right and which ones to move in and out of, and how to pick an underlying index or stock to do an options trade. Oh, you're welcome, Matt. Welcome, Matt. Just read my own name off the thing. You're welcome, Andrew. All right, yeah, let's get this going. All right, that's it for today, guys. Appreciate you, and I'll see you tomorrow on Tech Tuesday.